Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now, central bankers stole the limelight over the past 24 hours. First up was the US Fed's Brainard, whose comments were notable not only because she's awaiting confirmation as the Fed vice chair, but also because she's usually viewed as a dove, or one favoring relatively less tight policy, at least relative to other key Fed decision makers. Now, Brainard said it was of paramount importance to get inflation down, warning that the Ukraine conflict could put further upward pressure on commodity prices and that China's efforts to contain COVID-19 risks extending supply chain bottlenecks. Now, Brainard said the Fed would begin a rapid reduction of its balance sheet as soon as its next meeting in May and take stronger action on raising interest rates. Now, all of these comments meant US equities turned lower overnight, with the S&P 500 falling about 1.3% for the day, but Treasury yields continue to rise, with the 10-year yield surging all the way to 2.57% as I see it on my screen right now. Now, this jump in bond yields mean Asian markets will likely open the day with one big headwind, but it's not all doom and gloom. Recall that as inflation rises, the nominal sale price of a company's output also rises. So as long as costs don't rise at a faster pace, this can actually still help preserve or even increase nominal earnings. This is most probably why we continue to see earnings expectations for US equities, for instance, continue to rise despite the rising bond yields. The other lens, from a market perspective at least, we'd keep an eye on shorter term is how the S&P 500 behaves relative to key technical levels. Recall we discussed at the start of the week the importance of the 200-day moving average, and for the S&P that's now at 4490, less than 1% away from yesterday's close. Now, holding above the 200-day moving average, of course, could brighten the outlook for the index considering how much Fed action is likely in the price. Now, that's on the Fed, and while the spotlight was very much on US markets, the other key central bank that met yesterday was Australia's RBA. While policy rates here were left unchanged, it did remove a reference to being patient regarding rate hikes, setting the stage for lifting policy rates later this year. Now, this is key for the currency in particular because while commodity prices, of course, have been one key source of support, currency markets currently are quite focused on interest rate differentials. It's a point we discussed yesterday with the Canadian dollar, if you recall. And this is important in the face of what's turning out to be a strong US dollar that's being led by rising bond yields in the US. Now, unsurprisingly, the RBA decision led to a jump in the Australian dollar, which broke above technical resistance at 75.55 cents. Now, one always wants extended position to normalize a bit after such sharp moves, but we continue to see the Aussie as preferred, with technical suggesting the next key level from a technical standpoint sits at 76.6 cents and 77.6 cents. From a fundamental point of view, of course, we keep a close watch on employment and inflation data due later this month to confirm the RBA's direction. So, overall, watch for a potential S&P 500 bounce from the 200-day moving average and look for opportunities to ride Australian dollar strength. These are two ideas emerging from what has turned out to be a central bank heavy day. Of course, it's not all over yet because we have the release of the key Fed meeting minutes tomorrow, but I'll be back with that tomorrow with a little bit more on that. If you enjoyed this podcast, please don't forget to rate and like it. Thanks again for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.